Thank you very much. Ladies and gentlemen, you know when you're traveling on the motorway and the traffic slows down and you don't understand why, and after sitting in a line of traffic for about 10 or 15 minutes, you discover, unfortunately, there's been a road accident on the other side. And of course, the natural reaction is to slow down and to watch. This is the part in the proceedings. This is the car crash part of the presentation. What am I going to discuss? Why don't I prepare for these things? I've had an interesting few days. On Sunday, I was on the beach. It was 30 degrees. On Monday, I was stopped by Norwegian immigration. I don't know why. I mean, perhaps I was wearing a baseball cap, sunglasses, and a linen jacket, and it was -10 outside, and they were suspicious. This morning, I ended up in accident and emergency, and so I'd just like to dispel any rumor that it involved having super glue on my hands or anything else embarrassing. But I'm back, I'm better, albeit my ear is a little bit ringing. And life is cruel. People keep getting younger. The Joseph Stiglitz interview was broadcast on British television 6 years ago, 2010. As I say to my children, I used to be a big deal a long time ago, 6 years ago. I was at a party recently with some younger girls who represent some fund of funds in New York. And I say, yeah, I'm in global macro. I run Eclectica. Nothing. Had never heard of me. So if I may continue with the introduction, I feel now that actually I have to introduce, who am I? My shrink says I've got to get over it, that I keep wishing to express my identity. My identity lies in an envelope, a post-dated envelope, which is going to come through my door in 10 years' time. That's what I was saying 10 years ago. And now I'm saying it's another 5 years or maybe another 10. And on that number is my compound growth rate. Yeah, I'm that silly person that somehow defines myself by performance. It's preposterous. For what it's worth, if we use that definition, the thing that gives me confidence to stand in front of you, to be as audacious as to offer my views to you, is that I have survived. I'm like that when you spill red wine on the carpet and you scrub it and you scrub it and you scrub it, and that stain just won't come out. It's difficult to get rid of me. I've been running a global macro fund for 14 years. One of the longest running London macro teams. Not the largest, but one of the longest running. And we have compounded at 8%. I wish it was 18%. I would still be on the beach if it was 18%. But with 8 comes with a degree of accomplishment, I believe, because that 8 has been achieved with a set of returns which just have not correlated with anything. Not with other macro managers, not with the equity market, not with fixed income, nothing. I am eclectic. Now, in my recent years, I've been unfortunate. People interpreted that as negative correlation. Negative correlation to the equity market as an explicit strategy for the long term is ridiculous. Okay, so I wish to dispel that notion. I target very, very low correlation, and of course, I strive to achieve 8 to 10% returns. And what I wish to talk about today is the notion of imbalances, crises, and rebalancing. And let's begin. I am amazed by this chart. And this chart requires some explanation. With global macro, I have the wonderful luxury that my clients give me the ability to invest in anything. And the one caveat that I put on top of that is, I'll do anything, but it has to be liquid. I don't do illiquid. I need the intelligence of a market price, of the movement in market price. And I survey different asset classes. And so to prevent some form of illusion, because different asset classes, as we know, have different price volatility. The Chinese equity market today has price annual volatility in excess of 30%, approaching 40%. German equities over 20%. The treasury market about 10 to 12% today. The euro dollar 5 or 6% price volatility. So in order to kind of gain some impression of how one asset class is performing vis-a-vis another asset class, of course we have to put it on some constant basis. And so typically we would adjust for the volatility. So this is the performance of the S&P versus holdings in 10-year treasuries, but owning lots of 10-year treasuries, owning so much 10-year treasuries that they have the same volatility as the stock market, and rebalancing that portfolio each month such that that mandate is constant, that the volatility on both sides of the portfolio are constant. Apologies for being boring. But this chart is not boring. Since the early 1970s, the S&P has lost 75% of its value vis-a-vis risk-free securities. You might stop me and say, well, they're not risk-free if you vol adjust, and fair enough. I have to say to you, when we vol adjust, I'm not sure how this price series should look. If I didn't know the answer, I would probably guess it would be some form of mean reversion, that you would have periods of under and out performance. But to lose 75% is remarkable, and I think it begs an answer. Why has it happened? Because why have equities, China has problems, and we will have to discuss those problems further as I continue. But in the last 35 years, we have seen an economic miracle. Today, our economies in Norway and in the West, of course, are polarized by those who have much and by those who have very little. But over and above that, in the context of the last 35 years, we have had an economic miracle which has impacted positively on the lives of billions of people. It has made them richer. We have had the greatest synchronized global world trade in over 100 years. Over that period, we've created Microsoft, Apple, Facebook, you name it. And yet, equities have lost 75% of their value. And I've drawn a circle around the last part of the chart because since the advent of quantitative easing is this weird thing. You either get it or you really, really dislike it. Again, I may touch upon that later. But I think from this chart, we can begin to postulate, perhaps, an achievement from quantitative easing in that so far it has stopped the underperformance on a risk basis of equities versus bonds. And I think that is something to be satisfied about. Because I think I have to go forward. This chart, of course, we know global debt to GDP is high. We know it's very high. We know it's never been higher. We know the last time it was at highs was, of course, in the 1920s. And we know we had 40 years from 1930 to 1970 of deleveraging. 1970. So really, round about the basing of this chart represents the high watermark for equities versus bonds. So that's interesting. So in attempting, I have no answers. I can only guess. I'm sharing with you my guesses. I would guess that this phenomena is a function of the fact that a previous generation were shocked by the inflation of the 1970s. Investors were shocked, policymakers were shocked, households were shocked. And as a result, we got new policymakers. We had Paul Volcker, of course, famously arriving as Federal Reserve Chairman in In 1979, he raised interest rates by 100 basis points on a Saturday morning. It was a different era of central banking. And again, thank goodness the world is, I believe, dominated by strange things. Strange things keep happening. I call it irony and paradox. It sounds more intellectual. Just weird things happen. You get a new chairman of the Federal Reserve, and in a recession, he raises interest rates. He says, I'm a new sheriff. We've been lying to you. There's inflation. That's the bad news. The good news is I'm going to kick it out of the system. If we were to put ourselves in the shoes of speculators when you hear that announcement, what would you do? You would buy 10-year treasuries. What happened? 10-year treasuries collapsed. What else happened? The gold price went parabolic to the upside. It's just weird. We live in a weird world. 30-odd years later, we got another central bank. Famously or infamously, in 2003, said, we cannot have deflation. I will print paper. I will use helicopters. I will spread it. We called him Weimar Ben. What happened? He was the Federal Reserve chairman that resided over the lowest 10-year treasury bond yield ever. Try my job. It's hard because weird things happen. But anyway, back to this phenomenon of why equities have stunk versus fixed income. I mean, that chart really is why we have the Bridgewaters and why we have, I manage nothing. Brevin Howard managed $20 billion. Why? Because fixed income has been so dominant and because Alan's a genius. But again, back to the reasons. So we had this shock. We had new policymakers. Monetary policy was tight. And another phenomenon, I think it was 1982, the New Zealand Central Bank came out and they offered an explicit inflation target. We are going to coordinate our activities and we're going to target a 2% inflation rate. No one ever really tried to work out why 2 was the right number, but it was a low number, so it sounded good. So policy making changed, and at the same time, for at least 10, if not 15 years, in the emotional mind of investors, in the dark chambers of the mind, there was always the fear that the inflation would come back. And so, if you will, the forward curve and inflation expectations always remained high. So I think there's a degree of rationality to argue that interest rates, in real terms, were higher than they needed to be. And then perhaps just emotionally as we were getting over, with time is a great healer. And as we were getting it behind us, this travesty of the 1970s, 2 remarkable things happened. Globalization and the internet. And alone, individually, they are profoundly deflationary. You know, China, where are we? China. Steel capacity. Chinese added 1 billion tons of steel capacity. I mean, 10 times the American steel capacity. You know, that's a lot of steel. That's a lot of deflation. And another 1 billion people. In the UK, in the misfortunate economies outside London, they still despise Margaret Thatcher. It was her fault that they lost their jobs. Now, you know, you can have your view on Thatcherism and any other political allegiance. It was globalization. You know, in the UK, we used to send brave men miles underground to dig for coal. You know, you could ship it in from South Africa at 20th of the price. Life had to change, and life changed. And yet, policy making. And I say this not as I'm not attacking central banks. I say this to you with hindsight. So it's easy. It's easy to postulate. I think we can say with hindsight, for the last 30-odd years, monetary policy or interest rates have been too tight. Now, what is the significance of that? And again, I'm only postulating in front of you. The significance of that really is that the economy can be split into 2 halves. Over here, we have the creditors. Now, these guys, they've got a surplus of money and a deficit of ideas. And over here on the funky side of the room, we have the debtors. And the stock market typically captures the debtors. The debtors, the entrepreneurs. a profound surplus of ideas, but empty pockets, a deficit of financing. And the genius of our market economy is it brings us into the same room, and the system works. And what I'd want to argue is that the presence of the inflation shock in the 70s, and then the advent of globalization and technology, the profound technology shift, meant that real interest rates were high, and what we were doing is we were imposing an excessive transfer levy, that the bankers, if you will, got over-rewarded for lending to the entrepreneurs. That, to my mind, is the only way you can explain why, on a vol-adjusted basis, the S&P lost 75% of its value. That, if you will, we imposed, this side of the room imposed a rent on you guys. Now, when you offer this enormous carrot, when you over-reward the endeavor of lending, guess what happens? Let's see if my slide says. You want to lend as much as possible. So I wish to say something contentious. I wish to take you through the prism of the first decade of the new century and everything that happened in America, and I wish to suggest that there was an unbelievable desire on the part of the global creditor community to lend money because it was over-rewarded. And that's why we ended up with ninja loans. No income, no job, no us. I don't care. Take the money. Take the money. But in the absence, because of the transfer levy, the returns were never sufficient. There was always still too much leaking to the other side of the ship. So the ship was never in balance, which is why debt continued to rise. We had some kind of equilibrium. The ship didn't sink, but it was very vulnerable. And of course, when the first wave came through in 2008, we became very, very aware of the vulnerabilities, and we had a series of crises. And back in 2012, I was reading my newsletters. I have the misfortune of every month I have to reveal my inner thoughts. It's a very, very unpleasant endeavor, but it serves, certainly for me, as a mark of where I get things right, where I get things wrong. It's full transparency. And back in April 2012, we made the point. It started in America, and of course in 2012, we were very aware of the ramifications in Europe, with the poster child of sorts being Greece. But at the time, we were also pointing to the fact that the final shoe would drop, that the genie which had been released from the first wave of the crisis back in 2008 would finally manifest itself with the last crisis, and it would most likely be China. So China. Between 2010 and 2012, I was amongst the most prominent global critics of the Chinese system. I was the guy with YouTube videos. I was the guy insulting Nobel Prize winners. No one wanted to hear it. It was going to grow at 10% per annum to infinity. Nonsense. It was a dysfunctional model. If you're aware of the British retailer Tesco, China was like one of these growth retailers. You get you start, your business is good, you get a stock market rating, your earnings are growing, and now you have a mousetrap. To maintain the rating, you need the growth. And so you design a system which produces earnings per share growth. It's easy, especially easy in retailing. Open more stores. Earnings go up, okay? But to the astute observer who records incremental, marginal rates of return on new investment, you see a travesty. You see a great warning, a prophecy of danger. And of course, in Tesco, that was revealed, I think, last year. But we saw that in Starbucks, I think, about 10 years ago. It's written large in the history of retailers. And of course, we've seen it happen in China. Now, 10 years ago, no one wanted to hear it. I was just this kind of angry, crazy guy. So you might say, hey, we've just started the year. The worst start to a year ever. And it's because of China. And I say to you, good luck. I had to live All the things you understand about China, I had to live with them for 5 years. And when you can see this car crash, you know what? You really don't want to take any risk. I didn't take risk. For 2 years, I didn't take any risk. I had can you believe I had $1.5 billion? To me, that's a big number. I had $1.5 billion of AUM. And I had clients who thought I was negative correlated to the stock market, and they were fearful. Investors are fearful. It's one of the most bullish things about stocks today, apart from their profound underperformance to fixed income markets, which has, for the last 5 years, has stopped, and so it gives us signs of optimism. But I'd say to you, if there are any positive features to the global equity markets today, it is that we are terrified that having lived through 2 stock market crashes of a proportion that rationally you would anticipate would occur once every 60 to 80 years, we got 2 in the space of 10 years. We're now convinced there's going to be another. There's going to be the mother of all crises. And it's most likely going to be China. And this time, we're not going to get caught. Okay? I got $1 billion. People are like, you're the guy. I made 50% in October 2008. 50. Paul Tudor Jones made 50% in October 1987. And rightly, he was deemed to be a genius. I made 50% in October 2008, and I was deemed to be some crazy guy. That's my life, full of interesting anecdotes. But anyway, so I know that the room's feeling is, it's going to happen again, and we're not going to get caught this time. And a funny thing happened. At the end of 2013, I wrote a letter to my new clients. And I began with the preface, what if I was to tell you that I'd become bullish on equities? Is that something you would be interested in? The resounding message was no. $1 billion walked out the door. They're like, what? Really? You're bullish? Now, this is cabaret. Really, I should be in show business. And bullishness, optimistic, bearishness, these are adjectives which are very, very demeaning to the endeavor of global macro. The subtleties of global macro doesn't recognize the polarity of these meanings, but when you're trying to express a view, if I have one regret, it was using the polarity of the word bullishness. But my client said, the market's up 30%. And now you get it? Really? And I had one client who said, gee, in 2013, I was flat. Actually, I was up 20 basis points. I was up, but I was flat. And he said, gee, if only you had been down 15, I could give you more money. But this kind of being flat, I feel uncomfortable. Again, we live in a strange world. So I'm running out of time on one slide too. The world is convinced that China is this shoe, that's the next shoe to drop. And again, by introduction and by saying goodbye, the last of my big clients, I had amongst the largest North American pension schemes. So that was wonderful. The due diligence involved in the operation was a great sanity check. And they'd invested, each of them, more than $100 million each. When the last $100 million redeemed, which was August 2014, we made 35%. 2014, we made 10 for the year. Last year, we made 6. This year, we're flat. One of the best success stories we've had in the last 2 years, and the biggest profit stream, has come from China. In 2014, we made over 10 percentage points, I think about 12 to 14 percentage points. And we did so in Chinese fixed income. There are 2 markets for the Chinese currency. There's the offshore market and the onshore market. And back then, as the renminbi appreciated, there was a great carry trade, and so there was a great surplus of money sitting in the Hong Kong offshore market, which was in CNH. And all of this money is like a swimming pool. There was so much of it that it meant with such liquidity, overnight rates were incredibly low in the offshore market. Whereas in the equivalent onshore, so behind the barrier of the capital controls, interest rates were here. So it was a bit like the great European convergence trade from another generation when when you had to buy Greek bonds yielding 12 and they were going to converge with German bonds. You were buying essentially pari passu at the wrong price, which was the bullish. So in a bullish world where you had further liberalization of the capital account, then there would be a force for these two interest rates to normalize or to converge together. And in a bullish world, they would converge with the offshore modestly coming up to match the offshore. In a bearish world where I'm wrong about China, and China blows up and it has a catastrophic, and we have the mother of all bear markets, then you're paying interest rates. And so as liquidity gets pooled, you make money. So 2014 was bullish liberalization and we made over 12%. Last year we made about 6% because we only had that trade on from the mini deval of August of last year. And they underestimated the powers that they were unlocking, and it pulled liquidity out of the market. I was paying rates and we got rewarded. And the last 2 days we've been very rewarded for that trade again, which is why we're flat on the year despite the worst start to equities in a long time. Commodities, and again, another thing to you, for 14 years, I've never had a phone in my office. I spend the majority of my time getting banged on the head by the boom on my laser. I do a lot of paddle boarding. I sit on my own. I'm not very good in the company of others, as I'm sure you're guessing. But I think, with the greatest of respect to bank credit analysts, I've never read it. I've never had a call from a buddy at Goldman Sachs, JP Morgan, Morgan Stanley. I don't speak to anyone. So I am the author of my own mistakes. But I want to tell you, I'm very, very good at making mistakes. I'm very, very good at making mistakes. Mistakes don't kill me. In August, when we had that deval, I was 150% long, or I was 150% short dollar CNH. So I was long the renminbi. I lost 20 basis points. I'm very good at making mistakes. It was very, very good to be bearish on China between 2010 and 2012, because the consequences of being wrong were kind of boring, you know. And I could buy Australian interest rates, the 2-year rate 3 years forward, or the 3-year rate 2 years forward, whatever. And it was telling you that Australian interest rates today would be 7%. Okay, so that was a good trade. But I'm going to, anyway, so in commodities are bad. Okay, we have cycles. The cycle's over. Do you short commodities now? Really? It's a bit late. Do you buy them? Really? The cycle's over. So you look for other opportunities. There are always opportunities, okay? The movement in commodity prices is fantastic for those countries who import commodities and have large consumer markets. In the Western world, the US, the UK would be an example. And let me show you why it's fantastic. It's fantastic because when China was growing, and it was Tesco, it was Starbucks, it was throwing all this capital, it was imposing a growth tax on us. And the growth tax can be seen very clearly. What we're showing here is the headline rate versus the core. The headline rate was way above the core rate. And it made, in real terms, consumers felt poor. They had the worst recession ever. In a recession, the only good thing about a recession to households is that the oil price gets lower and it's cheaper to fill the car up. You've got a little bit more, thank goodness, because times are tough. It didn't happen this time around, which is why we had this great crisis in the political economy. Households were deeply unhappy, and it's why we've been feeling the pressure with the rise of emerging and angry political parties, and we're still seeing that thrash out in the US elections. But with the advent of a new Chinese model, look, the growth tax has gone. So I'm going to stop. I am over, I think, by 4 minutes. I really should stop. And please ask questions, and then I can go away and I can go back to the beach. Thank you very much, ladies and gentlemen.
Thank you, Hugh. Mark Twain as you know, he said it ain't the things you don't know that get you into trouble. It's the things you know for sure that just ain't so. So on that note, I'd like to ask you, Hugh, what do you think are the most important established truths in the market that just ain't so?
It's the value of the Chinese currency, the renminbi. Why should the renminbi devalue? Why? Why? So I have to tell you, again, I had a Damascus conversion. I was one of those angry, curmudgeonly Austrian economists. I made over 30% in 2008. I won. My AUM halved, which is fine because I have a very liquid, you invest with me, you want the money back, you get the money back. Okay. And so I was an ATM, fine. But then you had this QE, and then all of those people who didn't see it, who took those reckless bets, they all came back. We had a chance to kill the vampires, and we missed the chance. You know, the Mellon quote, purge the system of its rottenness. We failed to do it. That's how I lived. One should never be angry. It's such a negative force. And I've got over that. And I'm dealing. I said to you, I've survived for 14 years because I'm good at making mistakes. So I have rules, okay? And one of the rules is the discipline of time. And I give myself a lot of luxury with time. I get 2 years to be wrong. Because in being wrong, I never lose a lot of money. I'm just boring. I'm like a volcano. When I get it right, I erupt and I make a lot of money. And then I'm waiting, and I'm waiting for my 3-year vision to come right. And so I go sideways. My clients redeem. They've gone, and then I get it, and I make money. Okay. So renminbi is the key to the markets today. The greatest the economy which benefits mostly from the end of the commodity cycle is China. Okay. If you look at the terms of trade, currency markets are, again, fugazi, wugazi, fugazi. I mean, who knows how you trade currencies? They seem to have a law of themselves. We can use purchasing power parity. It doesn't work. We can also look at the terms of trade. And there's a degree of relationship. Currencies tend to move with the terms of trade. The Brazilian real has collapsed with the commodity cycle. That makes sense. The Russian ruble, likewise. Mexico, likewise. On the other side, the renminbi was appreciating. The terms of trade are very strong. China has had a deval in its currency of 50%. When you look at the global export share of Chinese manufacturing, it continues to go higher. China does not need a devaluation. China has 2 issues. Yeah, growth is slowing, and clearly it's had dysfunctional investment. Those problems are not solved by a devaluation. Not solved by a devaluation. So, to my mind, I think the Chinese currency is actually remarkably undervalued. I think we're in that kind of weird part of the market where people are thinking it's not Thailand, okay? It's not Thailand. So back to my rant about central banks. They were right, I was wrong. So the notion that quantitative easing has distorted the integrity of market prices is kind of right. But it's kind of right in a benevolent manner, because without the courageous intellectual decision by the American Federal Reserve to introduce quantitative easing, shortly followed by the UK Bank of England, I think, without a doubt, we would have had another Great Depression. So quantitative easing has influenced the integrity of market pricing because it took away the tail risk, the very real and relevant risk of a depression. In that sense, with more effective policy making, equities are worth more. And I believe that you can separate economies. There are your Thailands, there are your Mexicos, there are your Brazils. And if you will, they're the lower tier of sovereign nationality. They don't have sufficient size in terms of an endogenous consumer household market to determine their economic affairs. They're too beholden on international flows, either on the capital account or on the trade account. And then above that, you have Europe, America, Japan, and I say to you, China. Endogenously, they're large enough where they can run economic affairs and monetary policy on on their own without worrying about the currency. So I think there's a profound misunderstanding about the world. And the other 2 points I wanted to make really was that I mentioned the growth tax being abolished, if you will, on us. We're feeling, our households are beginning to feel richer. They might not be telling us it, but statistically they're beginning to feel richer. And so 1914, Henry Ford he doubled the salary of his engineers. And the paper said, this guy's crazy. He was a genius. Right? The problem with the polarization of our society today is that we're not rewarding workers, and therefore we're not rewarding consumers enough, and we can afford to reward them more. When Henry Ford did it, his profits soared. Productivity soared. He got the best engineers. No one left. But most importantly, he was empowering the consumer to buy more of his product. And it was a virtuous circle because when they bought more of his product, his productivity went higher and his profits went higher. And so the shift in Chinese policy is affecting us globally. For the last 5 years, China has been paying people more money. China for 20 years was boiling a frog. You know, you boil a frog, they're in a jacuzzi, and this is really nice. 5 minutes later, they're dead. So if you were a peasant, you'd move from the countryside to the city, and you had a job, and you're like, wow, I'm making so much money, and I can send money back to the folks on the farm. Now, the point was, you were being paid maybe 1/10, if you were lucky, of the incremental productivity that you were bringing with your endeavors from the switch from the countryside to the metropolitan area. In the last 5 years, what we've seen is with the policy switch to endogenous Chinese growth, you're being paid more. So households in the East now are getting to share more of the productivity that was owing to them. Japan has explicitly targeted higher wages. It's Henry Ford. In the US, every major federal government is targeting higher minimum wages. In the UK, it's an explicit target. So I think that's one of the routes. And then lastly, if we go back to that chart of S&P versus treasuries, we've succeeded. We had to destroy this excessive transfer levy that the bankers or the creditors were imposing on the entrepreneurs. Okay? So now the entrepreneurs get to keep more of the just rewards of their risk-taking ability. That's how slowly but surely we begin to dig away at this surplus of this deficiency of demand. So strangely and uncomfortably, I'm no longer profoundly bearish. I think we're going to be okay.
Thank you, Hugh.